This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
We now turn our attention to the last, indeed, of the personal taxes. Some may say, indeed, the final personal tax. There is that old expression that you may be familiar with. You can't take it with you when you go. Yep, you're afraid you can't take your assets with you when you die. Reason being, HMRC. They are there to take their share of the value of those assets when you die in the form of this tax, inheritance tax. Now, again, there is literally no escape from taxation. From the moment that you're born, you become liable to the various personal taxes, though probably to begin with, not too many of them will be applicable to you. But through your lifetime, you'll have income that is chargeable to income tax. Through your lifetime, you may have chargeable disposals of chargeable assets, and you being a chargeable person, you suffer capital gains tax. On your earned income, employment income, or indeed your self-employment income, your trading income, there's national insurance contributions that are chargeable. And as we'll see, when you die, or even before you die, if you really want to pay IHT, you can pay IHT in lifetime indeed, as we'll see. But certainly when you die, this is the main situation, if not indeed the one situation that for the majority of UK taxpayers will be their only experience of chargeability to inheritance tax, or as we'll call it now, IHT from this point on. So for most taxpayers, their only contact with the IHT system is when they die. And then it's a fairly simple exercise of basically preparing like a little balance sheet for the taxpayer on the date of their death, listing out all the assets that they held and taking away any liabilities that were due at the date of death. And that computation that you may well be required to do in answer to an examination question is known as the chargeable estate. We prepare a computation for the chargeable estate. As I say, a simple listing of the assets held by the taxpayer when they died, less, to begin with, any liabilities that may be due by the taxpayer. You owed maybe the taxman again there, maybe a credit card bill, any loans outstanding. All of those would serve to reduce the value of your so-called chargeable estate. Now, just because you die with an estate, you own assets, it doesn't mean to say that you will necessarily pay any inheritance tax. Because to begin with, there's a very, very pleasant rate of taxation. The nil rate band. There's a nil rate tax. Currently, and it's been this way for quite a long time, £325,000. But as soon as the estate goes over that level of £325,000 worth of chargeable estate, you move dramatically from a nil rate band to the excess over that nil rate band being taxed at 40%. This makes it a very serious tax charge. It means that for taxpayers who have estates worth over £325,000, and then depending on where they intend to bequeath where they intend to leave the assets held within their estate, to think that on that excess over the nil rate band, 40% of it may end up in the hands of HMRC, that's a pretty daunting prospect. Now, no matter how much from time to time we may dislike our children, I'm presuming here that we probably still do like them slightly more, on a good day anyway, than HMRC. So clearly this is something that needs to be planned for. Certainly when you come to P6 with just a little bit of involvement now at F6, we start to look at ways by which in lifetime you may seek to mitigate what would otherwise be your eventual IHT liability when you die, as the excess over the available nil rate band at that date is going to be taxed at 40%. Now then, we've mentioned there that for most taxpayers, their only contact is when they die. Let's calculate the chargeable estate. If it's less than £325,000, no inheritance tax is payable in relation to their estate. Anything over 325 will be taxed at 40%. But if it were only the assets that you still actually owned at the point at which you died, at the time of death, if only they were to be taxable, then something called, here's a lovely expression, deathbed gifting, i.e. giving away your assets just prior to when you died, would effectively avoid this tax. If I knew that I'd only got a very little time left upon this earth, and I'd got £1 million worth of assets that otherwise would feature within my chargeable estate, that would give a very large figure of IHT to pay, what would I do? I'd give them away now, while I was still able, while I was still alive. Now, that has got to be far too easy a way of avoiding IHT. So what happens, therefore, is that certain lifetime gifts, basically those made within the 7 years of the death of the taxpayer, they will also become chargeable on the death of the taxpayer. What we'll discover, therefore, is that the typical scenario that we may meet is, in an exam question, the taxpayer has died. This is what the taxpayer still owned when they died and what they owed at the date of death. You put that together in calculating the so-called chargeable estate. But in working out how much, if any, of the nil rate band is still available to go against that chargeable estate, we then have to look at the lifetime transfers, the gifts made in lifetime during the 7 years prior to the date of death, and they too will then become chargeable. And as we'll discover in these notes as we work through in the next few minutes, that the earliest of those transfers within the 7 years before death would be the first to take advantage of any nil rate band. In terms of lifetime transfers, we'll discover that most transfers that you make in lifetime would only become chargeable on death, and only then if you died within 7 years of having made them. But there are also some transfers made in lifetime, those into trusts, that will generate immediate chargeability to IHT, as well as further chargeability on death. So most lifetime gifts made where you give cash or whatever assets to your sons, to your daughters, to your grandchildren, nieces, nephews there, you'll notice I'm not mentioning the spouse here, your husband or wife, for as we'll discover in a few minutes' time, any such transfers between spouses or civil partners, of course, we recognise as having the same tax status as spouses, any such transfers between spouses are exempt for IHT purposes. But otherwise, if we make gifts, say for example most likely to our children, grandchildren in lifetime, then the only time that they would become chargeable to IHT is when you die, and only if you die within 7 years of having made those transfers. If I give away assets now and live for at least 7 years, then those gifts, those lifetime transfers, will not then be chargeable as a result of death. But if the nature of my lifetime gift was into a trust, then there are much more immediate IHT consequences. There will be an immediate chargeability to tax if I make a transfer into a trust. Now we're going to put names on these different types of transfers as we go through these notes, and no need for you to note these expressions now because we'll be coming to them very soon. But we've already mentioned that when you die, we put together a working known as the chargeable estate. That will be a list of assets held at the date of death and a deduction in relation to any liabilities due by the taxpayer at the date of death. We must also look at the lifetime transfers, and we must differentiate between those lifetime transfers to individuals that may become chargeable on death and those transfers into trusts that were both immediately chargeable when made and also then become chargeable on death, but only if you die within 7 years of having made them. Now we're going to have names on those different types of transfers. The transfers into trusts will be known as CLTs, chargeable lifetime transfers, CLTs there. And any other type of transfer other than an exempt transfer, for example to your spouse, those type of transfers, they have lovely names. They will be known as PETs, or PETs as we know them. We're all pet lovers, I'm sure. That's obviously an acronym, but PETs there for potentially exempt transfers. Why the name potentially exempt transfer? Well, as I've just said, if I make a gift now and live for at least 7 years, which I seriously anticipate and hope I'll do, but as long as I live for 7 years following the gift, what was potentially exempt when made would become exempt. But having made this potentially exempt transfer, if I don't survive for the required 7 years, then what was potentially exempt when made will become chargeable on death. So two main types of lifetime transfer that are going to have or may have inheritance tax consequences: CLTs, chargeable lifetime transfers, transfers into trusts, chargeable when made at, as we'll discover, a lifetime rate of tax, and also then there may be an additional charge when you die. Otherwise, transfers made that are not CLTs and which are not exempt transfers are PETs, potentially exempt transfers. No tax when made. If you live for more than 7 years, there will never be any tax. But if, as will be the case in an exam question, you die within 7 years of having made the transfer, then there will be chargeability when you die. Now then, in relation to these gifts, we need values. We need to have a value on a gift when made, either in lifetime or if as part of your chargeable estate at death. And that demands that we can calculate for each such transfer what we call the transfer of value. Now you will remember that back when we looked at CGT, for CGT to arise in relation to a lifetime gift, there has to be a chargeable disposal of a chargeable asset by a chargeable person. For IHT to arise either on death or in lifetime, there has to be a transfer of value. Now then, let's get to grips with what we mean by this. When we die, the transfer of value will be a very simple calculation. The transfer of value will simply be the market value of the asset when you die that is now being gifted to the beneficiaries. Now you may think that market value would always be the transfer of value, even on a lifetime transfer, but we'll discover that the meaning of transfer of value, though it normally equates to the market value of the asset when gifted, may be other than that in just one or two more interesting situations, maybe one or two of which may be eminently examinable in your exam. Right, let's have a look what we say then about IHT. Here's an expression we'll come to know and love. It is a cumulative donor-based tax. When you make a gift, clearly there is a donor and a donee. We witness that in capital gains tax there. This amount of tax, it's a cumulative donor-based tax. So the amount of tax that is payable in relation to any transfer is nothing to do with the donee, the person benefiting from this gift. It's everything to do with the donor. And the amount of tax is calculated on a cumulative basis. Which specific gift in lifetime you happen to have been the beneficiary of will determine how much tax is chargeable in relation to that transfer. So the amount of tax is based on the donor's personal circumstances, though as we will discover, it may very well end up, and it usually does, as being the beneficiary who suffers the cost of that tax. But the amount of tax has got nothing to do with the donee. The amount of tax payable is everything to do with the donor. And as we'll discover, we will work these tax figures out on a cumulative basis. For it to arise, for IHT to arise, an individual must make a transfer of value. Now, this is the term that we're seeking to define here. Clearly, it's a gift. Now, it's computed as the loss to the estate of the donee. It's therefore calculated as the difference in the estate value before and after the gift of the asset. It is the difference between what the taxpayer had before the transfer and what the taxpayer had after the transfer. The amount of tax that may be payable on a transfer of value is based, as we said, on the cumulative amount of transfers made by the donor, cumulative amount of transfers made by the donor over, as we'll see, a 7-year period. We've already stated that in relation to the main point of chargeability to IHP for the majority of UK taxpayers, it's when they die. But we only then wind the clock back to look at transfers made within the 7 years before death, for only they will be taxable as a result of death. But as we mentioned, you may make a transfer into a trust, a transfer made in lifetime, that is immediately chargeable there. So again, it will be based on a cumulative basis, looking at the amount of transfers made by the donor, and we will work on a 7-year rolling cycle. Now, more of that as we go through our examples. Now, as we've already said, for most assets, the transfer of value will simply be the market value. And we give examples of that here. Gifting a property worth £250,000 to your daughter. Before the transfer, I owned the property worth £250,000. After the transfer, I don't own the property. So the difference, therefore, this transfer of value, this difference between what I had before and what I had after the transfer, is very obviously £250,000, the open market value of the asset. Or I give away cash of £100,000 to my son. I had the cash before the transfer, I don't have it after the transfer. So very obviously, there the market value of what you are gifting is the transfer of value. But we said, for some assets, most notably the most likely in our exam, shares in unquoted companies, the transfer of value may be considerably higher than the market value of the asset being gifted. Now let's look at that in relation, we said, to shares in an unquoted company. Now let's set the scene here before we deal with illustration 1. Now, in relation to shares in unquoted companies, if you had the opportunity of acquiring a 1% interest in an unquoted company, where mostly unquoted companies are held in terms of shares by just a few taxpayers, again a group of friends maybe who got together to form a business, or families indeed. Now, would you be interested in buying in to a 1% interest in such a company? Basically, no. You can do nothing with your 1%. And because you can do nothing with it, anybody who would acquire it from you can do nothing with it. Again, the other members of the family there own 99% of the shares. Then you have no ability to influence that particular company, so it has a very low value. But contrast that with, would you be interested in acquiring a 51% interest in a company? Well, yeah, because then you have control. So my point, do you think that the value of a 51% interest in an unquoted company equals 51 times the value of a 1% interest? Remembering that 1% will be worth very little. 51 times very little is still very little. So no, what we realize and what we will see in our examples as in real life is that the value, the price per share of shares in unquoted companies will increase along with the level of shareholding. The price per share on a 51% interest is much, much, much greater than the price per share on a 1% interest. So with that backdrop, let's look at illustration 1, where we're told that A owns 60% of the shares in A Limited. A Limited has 100,000 £1 ordinary shares in issue. So we now know A owns 60% of 100,000 shares, A owns 60,000 shares. And we've been told that share valuations have been agreed as follows. This is agreed with HMRC. They even have their own share valuation division here. So we've got these agreed valuations such as would be provided to you within your examination question. What we've now got to do is to compute the transfer of value if A were to die, leaving his shares to his daughter. Now that will be the easier of the circumstances to deal with, or far more interestingly, where the transfer of value principle will be seen to be the situation where it can be far greater than merely the market value of what is being gifted. Alternative we'll deal with if you were to make a lifetime gift of 20,000 shares to his daughter. Right, let's have a look at our answer to this. The first one. If A died owning 60,000 shares, what did I have before the death? 60,000 shares. After? Nothing. How do we value 60,000 shares? It's a 60% shareholding. So looking at our list, 60% shareholding there, we would value those shares at £25 per share. 60,000 at £25 would be 1.5 million. A very easy calculation at that point of death. But if you're going to get a test exercise on this in your exam question, you'll be dealing with the calculation of the transfer of value where a lifetime gift is made of some but not all of those shares. Like here, if he were to give 20,000 shares in lifetime, the transfer of value would now need to be based on the loss to the estate of the donor. It would not be based on the value of a 20% interest. What is the value of what is being gifted? I'm giving away, or A rather is giving away here, 20,000 shares. That is a 20% interest in the company. How do we value a 20% interest? At £10 per share. Now, if you can remember your capital gains tax, if you were to give shares away in lifetime, then a gift is a chargeable disposal, shares are chargeable assets, and a gain would be computed based on open market value. So for CGT purposes, while you were alive, the implications of that gift are immediate. There would be a capital gain to compute based on the open market value of the asset, £10 per share. And this is where, interestingly, we can now see a link between our two taxes. That in fact, whereas CGT was immediately chargeable, take the open market value, 20,000 shares at £10 a share, that would be what market value of 200,000. Deduct from it the cost of those shares to the taxpayer, and you would have the gain. That gain is what would have arisen in lifetime, albeit, and I do hope you can recollect this, that if you gave away shares in an unquoted trading company, then for CGT purposes there is actually no need for an immediate gain to be chargeable, that in fact gift relief is available if jointly claimed by donor and donee. So you've seen lifetime gifts already in the context of CGT. Well, important now to understand that when that gift is made, there is a relevance for inheritance tax as well. The type of gift being made, we'll see the specific note very soon, but I've already mentioned to you, if you give away assets in lifetime to other taxpayers, other than exempt transfers, basically your spouse, and other than transfers into trust, those being chargeable lifetime transfers, they are known as potentially exempt transfers. So there'd be no immediate IHT chargeability. But it would become chargeable if you died within, I hope you're saying now, 7 years. And if that were to happen here in the case of A and his or her gift to the daughter there, his shares to his daughter, so If he died within 7 years of making this gift of the shares to his daughter, then we'd have to calculate the potentially exempt transfer, for which we'd need to know the transfer of value. Now, how would we compute that transfer of value? We would not look, as we did for CGT, at merely the market value of the asset being gifted, i.e. £10 per share on 20,000 shares would be 200,000. But instead, it would be computed as the difference between, remember what it was? What he had before the transfer and what he had after. The value of his estate before and after the transfer. So we simply make that comparison. Here, in relation to the shares being gifted, how many shares did he own before the transfer and what value did they have? How many shares did he have after the transfer and what value would they have? Before the transfer, 60,000 shares, which we know to be a 60% interest in the company, and to have a price of £25 per share. There it is. After the transfer, well, 60,000, he gives away 20,000, he owns 40,000 shares. Well, that will represent a 40% interest. Now, whereas a 60% interest was valued at £25 a share, a 40% interest is valued there at £15 per share. So let's work out the difference between what A had before the transfer and what A had after the transfer. Before the transfer, 60,000 shares at £25. We've already done that calculation, 1.5 million. After the transfer, 40,000 shares, now being a 40% holding, is valued at only £15 a share, 600,000. Look at the transfer of value we've computed, 900,000. So for IHT purposes, if A were to die within 7 years of having made this gift to his daughter, then there would be a transfer of value amounting to £900,000. Now, that calculation that we've just done there of the transfer of value in this scenario could be worth 4 or 5 marks in an examination question. Now, it's a very easy calculation to do once you've learnt the basic principle. Don't look at the market value of what is being gifted. That is the CGT rule. For IHT purposes, look at the loss to the estate of the donor, the difference in the value between what he had before the transfer and what he had after the transfer. That is the transfer of value, and if our donor sadly does die within the next 7 years, it is that that would become the basis of the chargeability to inheritance tax when A dies. A transfer of value will arise by the gift of an asset, as we have said, either in lifetime, like the gift of the shares there to the daughter, and or on death. For most taxpayers, as we've stated in our introduction, their only transfers of value will arise as a result of their death. That will simply mean what was the market value of the assets held when the taxpayer died, and that will go into their chargeable estate. I'd like you to just look again and maybe replay through what we've just been discussing. The calculations that we've just seen in relation to the transfer of value. As I say, that basic calculation of before and after, plus a few other things to go into then calculating the chargeable transfer. This is the start of the process. This gives you the transfer of value. Now that could be worth 4 or 5 marks. With a chargeable transfer, it could be worth 6 or 7 marks. So just go back through that, make sure you're happy with it, and also think about, you'll never have to deal with any direct interaction between the two taxes, but the fact that a gift made in lifetime may have been immediately chargeable to CGT, and a capital gain may have arisen, such as we've seen here, based on the market value of the asset being gifted. And then, to make matters worse, if the donor dies within 7 years, then the transfer of value arising may become chargeable to IHT. And once you've used up your nil rate band at a rate of 40%. This is a very serious issue. So just pause for a moment, go back, make sure you're happy with those calculations before we continue. Now, as we've said, for most taxpayers, their only exposure to IHT is when they die. And when they die, their only exposure to IHT is in relation to their death estate, their chargeable estate at death, i.e. the assets that they still owned when they died there. Because most people are not, unfortunately, in a position to be able to make gifts in lifetime, not of any substantial value anyway. And therefore, the only chargeability on death is the contents of their chargeable estate at death. So, the death estate, the chargeable estate at death. On death, the assets owned by the deceased are valued. We've seen there that there are certain valuation rules, i.e. what did he have before, what did he have afterwards. That is made very easy when you die, because what you have afterwards is nothing. So it's all about the value of what you held prior to dying. And that will be included in this death estate. If the deceased was UK domiciled, again we don't have to know detailed definitions of this, but anyone who is UK domiciled, then they will be charged to IHT on all the assets that they own. That means whether the assets are UK assets or whether they're overseas assets, they're all included. If you're a non-UK domicile, then the only assets that will be charged to IHT are those situated in the UK. But specific calculations that you may have to deal with. Now, probably the most likely and most valuable asset that any taxpayer has when they die is the property in which they live. So if they own that property, if a property held in the estate is mortgaged, again, depending on, hopefully by the time we die, we'll have lived long enough to pay off the mortgage that we used to purchase the property. That's the loan taken out to buy the property. But if the mortgage is still, or some of the mortgage is still outstanding, then the mortgage will reduce the property value if it is a repayment or interest only mortgage. Now, if therefore taxpayer died owning a property worth £400,000 and there was an outstanding, and it would say either repayment or interest only mortgage of £100,000. So own the property worth £400,000, repayment or interest only mortgage £100,000. What would you include within the chargeable estate? Very simple. You'd show going in, firstly, the value of the property, £400,000, and then reduce that £400,000 by the outstanding mortgage. Because, of course, as a result of the death of the taxpayer, now the mortgage will have to be paid off, and that therefore would reduce the value of the estate. So you would include, you'd show value of property £400,000 less interest only or repayment mortgage £100,000, leaving £300,000 to be included within the chargeable estate. Now I'm making the point about the type of mortgage, and be on the lookout for one particular word. Now you don't have to understand the meaning of the word, it's here recognition. That there are types of mortgages called endowment mortgages. Now, endowment mortgages are not deducted, as they will be repaid on death by the life assurance part of the mortgage. If you have an endowment mortgage, you pay an amount, usually of course we think of interest, every month. You pay your mortgage interest every month. But a part of what you pay covers a life policy, such that if you die during the period of the mortgage, the life policy you have will be sufficient to pay off the mortgage. So as a result of you dying, the mortgage is paid off by the life policy. Therefore, it is not owed. So if you saw that in your exam question, you would show value of property 400,000 less endowment mortgage, see note 1, nil, and include 400. Note 1 would say, as the mortgage is an endowment mortgage, this is not deducted from the value of the property on the death of the taxpayer. Deal with it. The estate should also include the proceeds of any separate life assurance policy. Obviously the endowment mortgage there, the life policy on that paid off the mortgage. But you might have separately been paying into a life policy, which will then become payable as a result of the death of the taxpayer. Now, in relation to that life policy on the deceased life, it is what we include is the proceeds. We will include the proceeds of that policy. What they might also tell you would be the market value. We don't use the so-called market value of the policy at the date of death. Ignore that if given. We use the proceeds there. Now, those are a couple of little valuation rules, which are the only ones that we need to be aware of at this level. There's a lot more valuation rules that we need to take account of and deal with at P6 Advanced Tax, should you go on to deal with that subject. Now, we also said that it was like a little balance sheet. Yes, we list out the assets held, but reduced by any liabilities due. Now, of course, with the mortgage in relation to the property, that was specific to the property. We showed it as a direct deduction from the value of the property itself. But having listed out then that net value of the property plus any other assets held by the taxpayer at the date of death, then the value of that estate will be reduced by any legally enforceable debts. The typical ones that you get at the date of death would be credit card bills. We're also allowed to deduct any, they refer to reasonable, it won't be anything other, but reasonable funeral expenses are also deductible. What are not deductible against the value of the estate at death would be, now we said legally enforceable debts, would be any gambling debt, something like that. Or if you were told that the taxpayer had promised someone that he would pay something for them. Now, those are not legally enforceable debts, and therefore they are not deductible. We also said that we could deduct reasonable funeral expenses. They are allowable deductions. What are not are any expenses incurred in connection with the estate. These are expenses incurred by the people who are charged with the responsibility to administer the estate of the deceased taxpayer. These are people known as personal representatives, or you may see the term executors there. These are the people who deal with the estate. It is their responsibility to bring together all of the computations for IHT, to compute what did they owe when they die, what transfers had been made in the 7 years before death, to be able to work out the IHT liabilities of the taxpayer. So it will be those people. Now, in so doing, they may incur expenses. Those expenses, though paid out, of course, of what the taxpayer left in his estate, would not serve to reduce the value of the chargeable estate in terms of working out the figure upon which tax would be charged. What we also do is to reduce the value of the estate by any exempt bequests. And bequests are exempt IHT, as we have said, if made to a spouse or civil partner. Now, there are other exemptions that are not within your syllabus. For example, you can make gifts to charity, and that would be a deduction from the estate. But the only one in our syllabus that we need to know are gifts to spouse or civil partner. Now, those are the contents of the chargeable estate. Listing out the assets held, putting in the correct value for those assets, and where appropriate, making a deduction in relation to any loans on those assets, the repayment or interest only mortgage, not the endowment mortgage, bringing in the proceeds of any separate life assurance policy. Basically, it's a listing exercise. All you'll have to do is to copy out the values of the assets held by the taxpayer from the question. The examiner's got to tell you what those values are. All you've got to do is to list them out. You will deduct then any legally enforceable debts plus any reasonable funeral expenses. You will not deduct any non-legally enforceable debts, like gambling debts, or like when the taxpayer was said, oh, he'd promised he told someone he would pay a bill for them, their electricity bill, a hospital bill, or whatever there. Those are not legally enforceable debts. These are not deductible in deriving the chargeable estate. You would also deduct any exempt bequests, i.e. whatever you leave to your spouse. Now, after all the worrying things that we have said about chargeability to IHT, above the nil rate band, £325,000, you will recall, a figure, by the way, provided on your rates and allowances page in the examination. You'll be given that figure of 325. That above that it was 40%. But now understand that transfers between spouses are exempt, whether that's made in lifetime or on death. So when I die, everything I own will go to my wife. Why? Because she's told me that's where it's going there. Everything I own will go to her. Transfer a bequest to the spouse, no IHT. There will be no inheritance tax when what I owned goes to my wife. But of course, sadly, my wife also will not be blessed with eternal life, and at some point she too then will sadly fade away. And at that point, no doubt our ungrateful children will then be the recipients of that estate. Now when that happens, when it goes from her estate down to the kids, that is where IHT will become chargeable. That is where we would firstly have our available nil rate band, or indeed bands as we'll see, and it is above that available nil rate band that then the 40% tax charge will arise. A very significant tax charge indeed. Now, how that available nil rate band works and the calculation of tax that will then follow, how that applies, we will see in our next lecture together. Next one of many on this large subject of IHT, a subject that is likely to command a 10-mark question in section B of your exam, let alone any individual objective testing questions in section A. So it's an important tax so far as we're concerned. Okay, review through what we have spoken of in this introductory lecture, then we'll get down to the details of calculating IHT, both on death and in lifetime, in our next lecture together.